Lots of really great insights that Chris is going to share today. He's got an amazing background just being an executive leader at a lot of technology companies, but just his involvement in angel investing and being able to walk you through and provide some of the insights and knowledge that he's learned over the years about what that jungle looks like, from starting and doing that due diligence to actually maybe getting the money and hopefully getting the money from that due diligence. So Chris, take it away. Thank you for being here. We'll have questions afterwards, so please save your questions and we'll go from there. So.
Thank you. Thank you for having me. Look a little closer. So before we get started, before we go into the intro, I really want to shed some light on like the objective of the presentation. Right, we got some investors, seasoned investors, and also entrepreneurs on this in the audience today. Right, so you guys hear me?
Maybe maybe we'll move.
You might be able to put the base on the other base.
Yeah, there you go.
Yes.
Maybe.
We'll figure it out.
Yeah. Act like Guns N' Roses and just right up there on the.
All right. So welcome to this session on navigating the investment landscape. So today we'll explore some economic context and delve into investor behavior and spotlight sector ripe with like innovation and resilience. And together, we'll try to demystify the due diligence process, understand its pivotal role, and learn how to make some of your startups shine in the eyes of investors. So again, I'm Christopher Yang. I'm here to share my insight and experience to help you seize opportunities and navigate the challenges ahead. So as Holly mentioned, we'll have an interactive Q&A session toward the end. So, but feel free to engage and ask questions as you go as well. Before we get into, get to the next slide. Before we get into today's topic, allow me to share a bit of my journey. I'm currently serving as the VP of Engineering at Way, a brand you might recognize for its innovative product, a luggage product with battery. And with 2 decades in tech sector, I had the privilege of leading large teams in companies like Onriva, CTM, DirecTV, Ticketmaster. I've also been part of the journey of Onestop Internet, a digital agency before it joined forces with Nogan. As member of the executive board at TCA, Tech Los Angeles, I've been involved in directing significant investments in this space. I've done a good number of due diligence and have successfully led numerous deals on behalf of TCA. Got my degrees from USC in both engineering and business. Next slide. So, still not okay. Right.
It's not easy.
Would you be able to maybe?
Do you want me to hold the mic? Yeah.
Yeah.
Let's do that. Is this all better? There we go. Yeah. All right. I like this. Yeah. Before we delve into the intricacies of due diligence process, it is essential to set the stage by discussing the current investment landscape a little bit. Why is this important? Understand the economic context, investor behavior, sector focus, and the climate of startup provide really a backdrop against which the due diligence process operates. It helps us comprehend why certain aspects are emphasized before more than others, and how shifts in the landscape can influence investor priority and expectations. So this foundational knowledge will not only enrich the discussion today, but empower startups to better align with investors' perspective and navigate the investment journey more effectively. So that's beginning. So as you know, shrinking saving across households signal a potential reduction in consumer spending, a cornerstone of economic stability, right? So the escalating oil costs and not just numbers not numbers that it got spun this morning. It has ripple effect affecting production costs, transportation, ultimately prices of goods and services, right? So these factors coupled with a tightened grip on bank lending, really create a scenario where we'll anticipate a recession. This is really a tangible concern this year and next year. So moreover, the threat of a high interest rate is really a double-edged sword. On one hand, it's a tool to curb inflation, as we all know, but on the other hand, it's stifle growth and making borrowing more expensive and potentially slowing down investment, right? So it's much harder to get capital versus 2 years back. So for startup, this economic backdrop is like a chessboard, right? So each move, each decision is influenced by these macro factors. So understanding them is not just about knowledge, it's really a strategy. So remember, like challenges like these are also opportunities in my lens. A cautious approach to spending the investment can lead to more thorough evaluations of opportunities, potentially benefiting startups that can demonstrate real value, sustainable growth, and a clear path to profitability. So profitability is really the emphasis here. So it's about navigating the water with foresight and adaptability, turning potential challenges into like stepping stones. So let's look at some of the investor behaviors today. So investors, especially with experience, are well-versed in the cyclical nature of market, right? So they understand that volatility, while presenting risks, also unveil unique opportunities, as mentioned earlier. It is when true potentials of startup can really shine with innovation and adaptability. So market volatility is not a barrier. It's like a testing ground where your startup value propositions, your adaptability, your vision are put into test. In an environment where like alignment you would go through strategic investor interests can really pay way for fruitful partnership, right? So it's in this current environment, it's not just about showcasing what you have. It's about demonstrating how you align with evolving priorities, such as like value, growth potential, investment horizon, diversifications, adaptability, and agility. These are all things that investors are looking at and focusing today. Next slide. Yeah. So in today's competitive and yet, to be very honest, like cautious investment landscape, right? Merely being good isn't good enough, right? So startup must really stand out and must shine brighter than the constellation of options available to the investors. So how you achieve this, right? First and foremost, by demonstrating value, right? Not just in terms of potential revenue, but in the unique solution you bring on the table, right? Innovation is the lifeblood of the startup ecosystem. And those who lead with groundbreaking ideas are often ones who capture attention, right? Spaces like AI, automation, cybersecurity are still drawing a lot of investment. So being memorable and building compelling narrative are your ticket to securing investments. And moreover, resilience is key. The startup journey is filled with different challenges, and investors are interested in those who can really weather the storm and emerge stronger. Next slide, please. So having explored the landscape and its imperative standing out, let's delve into the heart of our discussion today, right? Demystifying due diligence. This is a pivotal junction in which your startup journey, a phase where scrutiny meets opportunity, right? They go hand in hand. So this is just it's not a procedural step, but really a comprehensive evaluation, a meticulous examination of every facet of your startup. It's a lens through which investors view the intricacies of your business, seeking to uncover both a gem and grit. It's a process that peel back layers, reviewing the core of what your startup is and what it has the potential to become. All right, next. I'm going to skip a few slides in the interest of time. Next, please. Yeah. So first area we really want to hone in is the management team, right? So some of the key focus area, including the background and experience, right? Investor will meticulously examine the background and experience of each member. They're interested in understanding diverse skills, knowledge, and experience to each individual bring to the table. What have you achieved in the past, and how does experience contribute to the success of the startup, right? Next, the role and commitments, the clarity of role on the team and the level of commitment from each members are vital, right? So are these fully committed like executive members instead of like fractional CTO, CFOs? Do they understand, do they have the clear purpose, understand their responsibility? Are they fully committed to vision and go to the startup? And also the team dynamic and decision-making process. How does your team work together? How do they function? Do they have a shared vision? How do they navigate challenges together? Whether or not they have a balanced skill sets, and then how you can showcase your team cohesions. These are all very important to us. Next, please. So as we transitioned from team to innovation, especially if you are operating a software or SaaS company, it's important to emphasize the technological foundation of your startup, how you differentiate, how you scale. Is your product unique? How do you demonstrate innovation and market differentiation? And more importantly, how do you protect your intellectual property, which is the portion of safeguarding your innovation? Discuss the measure take to protect your IP, including patents, trademarks, copyrights, trade secrets, etc. So we do a lot of like vetting, looking at patents or provisional patents and patents that were filed, and how that relevant to the business model and to operate. We dive deeper into the status of application and regulatory approval if you're operating in more so like a medical device, life science, a vertical where FDA is required. These elements underscore the viability and legality of your technology, providing reassurance to investors about the defensibility of your innovation. We look at tech stack robustness and future development and also your roadmap at the same time as well. Next, please. So let's delve into the next important section, which is really the product market fit and go-to-market strategy. This is really the blueprint that outlines how you plan to sell your product and services to the customer. It's about identifying who your customer are, where they are, and how you sell to them. So I think key components including like defining, understanding the competitive landscape, your target audience and market needs, detailing the approach to market entry, your CAC, your customer acquisition costs, your market presence, value prop, and competitive edge and future expansions. We look at a good variety of metrics at this stage. Next, please. So growth is like vitally important. We're not just invest in a profitable company unless you could demonstrate significant growth over time where we could really reap the benefit and have a sizable returns as an angel investor at the end of the day, right? So how you turn attention to the future, your growth strategy is really a compass that guides your startup toward scalability, market expansion, diversification, long-term sustainability. So it's about envision where you want to be and chart a course to get there, right? So strategy for your scalability, market expansion, your roadmap, and how that aligns with the market trend, or what are some of the challenges you might see and how you can overcome them. So there are KPIs in this area that we looked at as well. We'll get into those in a little bit. So can we skip to the next slide and we'll get into just the financial portion. One more. So the last most important part of this is really the financial narrative of your startup, right? So the financial story is like the heartbeat of your venture, indicating its health, vitality, potential for longevity. Is where numbers translate into insights and projection, paint a picture for the future, right? So we do a lot of in-depth analysis on the financial statements here. Break down your income statements, your balance sheet, cash flow statements, highlight the key financial ratios, your margin, liquidity indicators, that really set the foundation for understanding your startup and financial health. We look at financial projections, revenue growth, profit margin, cash flow, and that you're anticipating in coming years, and really be transparent about the assumptions you're making. Right? At the end of the day, these are like projections, right? We will scrutinize your numbers, but at the same time, as long as you can tell compelling stories around your forecast, we'll also buy into that. Your cash flow management is key. What is your burn rate? How much money, how much runway do you have until the next capital event? The risk mitigation strategy and some of the key financial KPI is what we will look at this particular phase. And more importantly, as I mentioned earlier, right, investors are looking at both growth and profitability just as much in today's environment. So that's actually very important. Finally, next slide. I want to emphasize that building trust with investors is vitally important, right? This is a foundation to any relationship. No different between startup investors. Transparency, comprehensive, like supporting our cornerstone in building that trust. So you want to make sure that you're organized, you're prepared, you're proactive in terms of addressing challenges, being transparent, and demonstrating your commitments toward like regulatory compliance, security, privacy, and then you want to be as communicative as possible at this stage. I mentioned about, next slide, I mentioned about like the legal risk and compliance risk earlier. So in general, understanding legal risk and compliance is vitally important, and be proactive about those risks, and be proactive about managing employee relationship agreements. So we'll also look at whether your executive has any sort of non-compete clauses within the agreements. We want to be as transparent as your investor, and if you're selling physical product, consumer product, making sure that you have sufficient insurance on your product side, and etc. And next slide. So I won't spend too much about on the exit strategy in the interest of time, but really you need to understand your vision for the future and how you can realize the return for the investment, right? Make sure that your valuation makes sense. Evaluate the timeline you propose to expect return associated with each exit strategy. Look at market chain, comparable exits, and make sure that your market multiple makes sense. And you're not quoting from numbers from 2 years ago, but really the market multiples in today's day and age. A well thought out exit strategy demonstrate foresight and preparedness as well, but will win trust from your investor. I might have to go over a few more minutes. I think the next few slides are actually quite important. These are like more from an investor's lens in terms of key indicators and red flag we see. I actually took some time last night to drop down like 15 of them that I feel are vitally important. And if you can address all of these concerns, I think you wouldn't have much of an issue passing your due diligence. So making sure you can demonstrate your team dynamics. The essence of a startup often reflects this in its founding team, right? A cohesive team with diverse skill set, which I mentioned earlier, is really a beacon of potential success, right? So a red flag such as frequent role changes or evident disagreement among founders can be concerning to investors. Second, market validation is crucial for the startup to protect its product or services and make sure that it's tested in the market. And over relying on anecdotal evidence or a glaring absence of market validation can be alarming signal. Third, customer feedback. We'll make sure that your product is well received by the market. Positive feedback and repeat business are strong indicator of value delivery. In the contrary, like persistent negative reviews or high churn rate can hint a deeper issue with your product and offering. Next slide. So moving forward, let's delve into the market positioning, compliance, and revenue streams a little bit, right? So we want to make sure the startup is well aware of its competitors and its unique selling proposition. An unclear competitive edge or a lack of market awareness can be another red flag right here. Regulatory acumen, and especially in sectors like healthcare or fintech, adhering to regulatory compliance is non-negotiable, right? So unfamiliarity with this key regulations is a significant concern if you operate in these spaces. Revenue sources, we look at this all the time, right? A startup's ability to diversify its revenue streams is vital, right? Relying solely on one revenue source can also be risky, and we'll get into revenue concentration next slide. So also a heavy dependence on a few clients for majority of revenue can be vulnerable for a startup. You want to be able to diversify your revenue sources in a more proactive measure against potential client losses, right? So we had businesses that only have a few big brands or big customers like Nike or Pepsi, and then losing one business means that you're really losing a majority of revenue, and in that case, it would really hurt the startup. Cost structure. A clear breakdown of fixed and variable costs is essential. If costs rise without a corresponding growth strategy, it also causes us a concern. You want to make sure the startup is scalable. The business model should inherently support the growth, right? If your scaling demand is linear, increasing linearly in terms of like resourcing, it raises questions about long-term viability in a way that if you increase your revenue at the same time you're increasing your fixed costs and human capital and other supporting resources, this could be concerning. You might have a growth issue down the road. And so next slide. I think we're almost there in terms of red flags and key KPIs. So we also looked at CAC vs LTV ratio. A skew ratio between CAC and LTV suggests marketing inefficiency or challenges in retaining customers. The next one is revenue type. In tech sectors, subscription models often offer more stability and one-off sales, right? So a heavily reliance on project-based revenue can lead to unpredictable financial performance. That just means that your revenue is most likely non-repeatable. So we have to figure out new sources year over year. Pivot patterns are very important. If you have raised capitals previously, while adaptability is commendable, frequent directional changes might suggest a lack of market understanding or vision. Next slide. So concluding our deep dive, let's look into a couple more indicators that provide insights on startup stability and efficiency. So we have the debt to equity ratio, which is one that we always looked at. A high ratio can suggest like over reliance on debt, exposing the startup to risk like interest rate and fluctuations. We also have gross margin. If margin are consistently declining, it could point to rising production costs, pricing challenges, or even like operational inefficiencies there. And finally, revenue sources valuation we talked about earlier. Want to make sure that you're not like using valuations from before. That's 2 years ago versus what the market is perceived being right now. We've seen. I've done a couple DD earlier in the year. We've seen valuations as high as like 30 million. So I have to really go back and like re-educate some of these founders that in today's day and age, right? I mean, anything that's in the C, pre-seed, I have not seen anything that has successfully raised capital over 10 million, right? So 30 is definitely way too much. And gladly, some of these founders are open to our suggestions and we have to lower their valuations. So particularly GitFact AI, which is the deal I led, and ended up raising a 4.5 million round. I forgot the exact number of valuations given it's been six plus months now. I believe it was in the 18 range. So that was more so an exceptions, but we did lower that valuation from 30. And going forward, I'll skip the next couple of slides, right? I want to make this more interactive. So let's just go to Q&A from here, if that's okay.
think we're gonna, we'll take the
It's like-
microphone from you.
Yep.
John, oh.
Oh, go ahead. Oh,
Good to see you.
All right, we're gonna give the mic to John. Thank you so much for that presentation. Lots of really great information. All right, John, take it away.
Thank you, Holly, and thank you very much, Chris, for the presentation. There was a lot of information there in
Yeah.
such a short period of time. So hopefully you guys took good notes. If not, then this will be recorded and will be on our YouTube channel. And you can review everything that Chris had to say. Does anybody have questions? Start here.
Yeah, Chris, thank you very much for that presentation. You just gave us a master class on due diligence. That was awesome. You know, I worked for a late stage tech startup for about 4 years, and in 2020, 2021, many tech startups were raising at just ridiculous and unsustainable valuations, 35, 40x of forward revenue kind of stuff, which was unheard of, right? I started my career in the mid 90s during the .com bubble, and it was very reminiscent. My question, this is primarily about angel investing rather than late stage venture capital.
Yep.
During the 2020, 2021 COVID years, were you seeing, even on the angel seed and pre-seed rounds, similar excessive valuations? And furthermore, a lot of people in the VC space were not doing any of that due diligence that you just walked us through. And so did you see that kind of behavior in the angel space? Obviously, probably not from yourself, but from others in the space.
So I'll break this down into like two different stages, right? So start with pre-seed because you don't have a lot of like demonstrated market traction like as early. I mean, a lot of pre-seed companies that we invest and back in the 2020, 2021 are some of them are like life sciences pre-revenue. So it's harder to use like market multiple to justify its valuation, right? A lot of time we use like a similar benchmark and kind of work in reverse, understanding what will be a good valuation to come in and still have a sizable profit in future liquidity events, right? So, I mean, it really depends, right? And the rule is that we try to invest in anything but that's pre-revenue, less than 5 or less than 3.5. I think that's a good spot to go in. And when we get into like maybe like C, when there's some AR, MRR, I think the definitely not. I mean, with TCA, I mean, every investor has his or her own investment thesis, right? If you are in the Silicon Valley, I've talked to some colleagues there, and I think they're doing all the moonshots, right? We just need one. I'm okay to play the 30x for multiple, but we're betting that the company will be the next Instagram, the next Facebook, right? I think that's one approach, but it's traditionally is the less lucrative approach for angel investor, right? So, I mean, we probably don't have the luxury of like staying on that long. A lot of time we get bought out even before an IPO event, even if it's a unicorn that we invested in. Sometimes we get diluted, right? So if we don't come in at a very low valuation, it's harder to get the IRR that we're expecting, right? I mean, traditionally, me as an investor, I look for anywhere like 23-25% IRR over like 5 to 7 years of like span, because you know that these are very early stage investment that you have to be very patient. I hope I answered your question. And if you guys are looking for some number and matrix, on average, I think the company valuations are usually around 8 to 10 per seed that we invested in. So we are actually being a bit more conservative.
That's a good quick follow-up. What's the general time horizon for exit for angel, like pre-seed and seed round? Like, is it a 5 to 7 year, or does it really depend on the type of company and industry?
Medical devices, like life sciences, would traditionally be a little bit longer given the regulatory approval process, and you got to be very patient in that space. Traditionally, we see a faster exit with software and SaaS company, but still, right? I mean, if you're coming at a very early stage, you got to be willing to wait at least 5 years to have a fruitful exit. You will see a few exits in the first couple of years with like potentially 2 to 3x multiple, or sometimes you might lose a little bit of money if it could acquire. But to get the really the jackpot in the sense, yeah, you really need to wait that like 5 to 7 years, and hopefully it will balance out all the losses that you incur over time.
Thank you.
More questions? You come up here, because Court isn't going to reach out like that. While this gentleman's coming up here, let me ask you a quick question about one of the earlier slides. You said that for Tech Coast Angels, and you remember that group that you've done about $15 million last year, 2022, which is interesting because it was at a time when interest rates started going up, and a lot of investors were looking at less risky investments because interest rate, they could get yields on interest rates. Talk about a little bit about what kinds of companies you invested in as far as that 15 million is concerned, and in what amounts, because you mentioned one company that you had led that dealt with artificial intelligence or AI.
That's right.
But what other areas are you guys looking at these days?
No worries. So it was an interesting year, right? And just like aside from individual checks coming from investors like us, right, we also have chapter funds, like 3 or 4 of them that are in operation. So we actually raised capital for 2023, or I mean we call it fund 3, right, which is like across 2023 and 2022 and 2023, even before the interest rate hike, right? So that kind of allowed us to still have the capital to deploy to startups that with a lower valuation. I mean, we're trying to reap the benefit, right? Because now it's harder to get capital. So our funnel has becoming a lot bigger with much better deals flow coming in. So I think that's a good thing. And it actually, in my opinion, it's a great time to invest in angel, doing angel investment, investing in early stage startup right now, given I think late stage valuation has gone down so much, and whereas in earlier stage you're looking for as an entry 5 to 7 years in terms of recognizing some of the returns. So hopefully by then, I mean, when the markets has come back on, right, the valuation will be a lot better. So you're coming in at the right spot with a lot of companies with low valuation. This is a great time. And to answer your question, more specifically, the type of company we invest. If I were to look at the pie chart, really is, I think a good majority of the company we invested in were in like life sciences and medical devices. I actually don't know why. I think that's just because how the deal flow was last year. We also had some hardware, a lot of some like consumer products as well. We have a software and SaaS company that's leveraging AI. I think that's a good mix, particularly in Southern California. We're actually not just investing in Los Angeles or Southern California company. Our investment is industry agnostic and spread across many different regions. We have like portfolio companies in Texas, New York, Northern Cal as well.
It's a follow-up question on your company. You have to be very patient on medical issues. There was a report by Catlin Cardinal, who just won the Nobel Prize for medicine for developing the COVID-19 vaccine. She, in an interview, said she couldn't get funding from anyone, and she worked in desperation over the years to develop the vaccine. Why did companies like yours miss that opportunity?
Good question. So I think there's always going to be some misses regardless. Just like early stage investment, you're so early, right? A lot of times, to be very frank, you're betting on the team to pivot, right? So, and as an angel investor, what we could do is really following the script I just presented, right? Making sure that you check all the boxes, right? The ability to screen out bad deals doesn't mean that you have a few misses, right? I mean, we're increasing our odds by going through this script, this process, this due diligence process. But like inevitably, you're still gonna miss some good deals, but you just have to live with those and make sure that you're not getting hurt by the non-investable companies.
Kevin, come on up. While Evan's coming up, let me ask a follow-up question. So talk about from the entrepreneur standpoint, the importance of finding the right investor, because we've had many speakers up here that talk about 3 categories of investors: the financial investor, the smart money, and the strategic. Financial, usually they're not going to be too helpful, but with the smart, with the strategic, it may help with the scaling a company, build a company, and it's also the exit. Talk about the importance of that.
I think different type of investors have different value at different stages. If you're really early, it's harder to tap into institutional funds. I think being able to leverage angels and people who have the connection and network is helpful. Will help you kind of speed up accelerate your initial like growth and development. But as you get bigger and more mature as a company, as a point, finding strategic partners with investors will help in terms of opening up more doors. And obviously, you want to be selective once you have some initial traction in terms of who to take the money from. But I think going back to what I mentioned earlier, right? It's in current day and age when it's relatively difficult to get capital. I wouldn't worry about the problem of getting oversubscribed. I'll try to grab as much money as possible. Make sure you have surrounding. Yeah.
Without too much dilution.
Without too much dilution, yes, that's good. Yeah.
Hi, thanks for speaking. I have a follow-on question to John's, and then I had a question I was going to ask. I was sitting back there. The follow-on question is, when you're looking for a mix of investors, can you talk a little bit through, having institutional investors, venture funds and so forth, versus strategics, and how those can combine to, because I guess the background to that question is, I worked for a company, we had a strategic investor, and then prior to that, it was just all angel. And the strategic investor, we realized at some point in our interests were not aligned, because of course they want to buy us for cheap, we want to exit for maximum. And so that didn't go as planned. And then my second question is, in terms of, in particularly the LA basin, the whole region from, I guess, OC to Ventura, what are you seeing is missing in terms of going from that angel to Series C, kind of spectrum? I know a few years ago, there was a lot of lack of sort of Series A money, plenty of really early and plenty of later. Then there was this sort of valley of death, as it were. But that's partly because of the funding situation and the activity, the level of activity in the region. So, and I can repeat these if you want to answer the first and the second.
I'll try to tackle them in reverse order, right? I think the money is still out there, as I mentioned earlier, that although investors are a lot more conservative in today's age and also try to diversify their portfolio across different stages. I mean, I'm more coming from an individual investor perspective. Obviously, if you are a fund, you're institutional investor, you're still strictly focusing on the stage and vertical. And so on that note, I think that the money is still out there. As I mentioned, if you could demonstrate like disruptive, obviously innovation and changes in like sectors or industry that hasn't been impacted by innovations and AI just yet, right? I mean, with the rise of AI and also cybersecurity automation, right? And in today's world that companies are trying to save. And any sort of automation, human labor reduction, any sort of those technologies still has high demand and still has high market, I would say, a good market to operate in. Do you mind repeating the first question again? Sorry.
I just, can you talk through the aligned versus misaligned interest of venture capital versus strategic money?
Yeah, this is a very good question, right? So when you're progressing into maybe like a C or Series A stage, right, and you want to make sure that like the founder's vision does align with the strategic investor you brought in, right? Because that was a great example that if there's some intentions to buy you up, like purchase you, and then and also my point of view from like at the board level point of view from working with particular sector, particular type of companies that deem to be competitors to their space or the business that they're operating, right? So you want to make sure you're conscious. What is your vision? What is your exit strategy? And whether these investors can help you achieve those goals or not, or do they become obstacles in terms of you getting into achieving that vision yourself? Yeah. Mm-hmm.
Thanks.
Okay, here, I'll ask a quick one. You talked a number of times in the presentation about knowing your competitive edge, right? And being able to present that to an investor. From the investor's perspective, how are they actually measuring that, like, as a startup, you really get the market landscape and what it is that you do better?
I think it's the competitive edge, as I mentioned many times, is really crucial, right? And it's we talk about really for honing on tech, right? Having something that's uniquely stands out from the competition, making sure that you create a strong barrier to entry, that you wouldn't be immediately impacted by, let's say, an existing player that will try to replicate what you've already built. So it's very important that you think through this, like just because I could do it, how can I prevent others from doing the same thing I'm doing right now, right? Is it the scale? Is this first to market advantage? Or is this something that's proprietary that I could do, no one else could do, right? I mean, if you can define that, really create an IP around that, it makes the investment or the deal looks very compelling and promising from investor sense. Yeah. Mm-hmm.
All right, I'm going to wrap things up with one last question. What advice would you give to this audience and others that are watching, as far as somebody that is interested in getting angel investing? I'm old school. I'm old, so there used to be a saying, "Over the transom." These are deals that just kind of come in through the door, and you don't know who the person is, and those type of deals are usually overlooked. But if somebody wanted to approach Tech Coast Angels, what kind of advice would you give that would like to talk to you guys as far as funding is concerned?
Well, that's a loaded question. I've seen a lot that companies came in unprepared, not knowing their edge. I mean, all these questions get asked during initial screen, not even before the due diligence process begins, right? So if you can't really articulate in front of yourself, you probably can't do that in front of an investor. Making sure that you could answer all the questions that we talk about in terms of competitive edge, the size of the problem you're solving, really the one-on-one stuff, right? Going through your checklist, making sure you're prepared. And you really understand that you have one shot, right? So I've companies coming in with like ridiculous high valuation. And once you lost the interest or the focus of the investor's part, you have to come back. They have so many deals in the flow and today, right? So it's you want to make sure that you are prepared for that meeting, and you have one shot to get it right. I think that would be I would say the most critical, most important advice I give everyone.
Colleagues, one more.
Yep. All right. Thank you, Chris. Thank you all.